Hey, everybody, and welcome once again. It's Capital Interactive with your hosts, Besim and Adam, the Boz. We have a very interesting episode today. We're going to talk about investment real estate, some of the factors that go into investment real estate from valuation and cash flows and various other topics. But we got a lot of interest in this topic based on our owner-occupied real estate topic that we had done earlier. So we figured might as well talk about investment real estate too.
Investment real estate's interesting. I know a lot of people have made a lot of money throughout the years on investment real estate. And so we're here to talk about how you finance it. I mean, Adam's got a lot of experience. He's financed quite a bit of this in his past. And I've done a little bit myself. So I'm really going to dig into Adam's knowledge, make sure he gives us the skinny on how this is done.
Stay with me, grasshopper.
Stay with you. Yes. So anyway.
Isn't that where I say take the penny from my hand and you got to be quick and take it from my hand? That's what this episode's all about.
I like your background.
Time out. You're such a... Oh, man. Okay, let's...
That's a nice right, door you got behind you. That's an idiot. I should have you by my office sometime. We could do this in person.
It's a nice virtual background you have, but it's a nice office.
I mean,
is that where you get coffee back there? Is that where you hold all your meetings? Your team meetings?
I mean, can you really trust anybody with a green screen?
Exactly. What are you hiding with that green screen?
All the books, all my knowledge.
This is all going to come out in outtakes.
I know.
Everyone's going to learn that you're full of you know what. All right.
Okay. Okay, Adam. Real quickly, let's from a high level talk about what exactly is commercial real estate, and we're in this particular case talking about non-owner occupied real estate. Right. Commercial real estate.
So non-owner occupied real estate obviously is real estate that you're not intending to occupy with the sole purpose of running a business or some operation. It's commercial space that you have purchased, you own with the intent to manage, rent, or lease out that space for investment income, for income that is derived from the rents paid by the tenants. That's a very high level view of what investment real estate is.
So just like for an example, if you had an office building and you're leasing it out to a whole bunch of different lawyer offices, that's investment real estate. If you've got a warehouse and you're leasing it out to an oil and gas firm, that's investment real estate. What if you have residential stuff?
Same thing. So any property you own where the sole intent is to derive income from leases, rents, or otherwise paid by third parties, that is your investment real estate property. It could be residential, commercial, industrial, warehouse, doesn't matter. So long as it's generating income by virtue of rents and leases, that's an investment real estate property.
All right, perfect. So we got the property that's generating revenue from the property is leases and rents. You're not actually doing any business in there. It's just you leasing out the space. Okay. Is there any difference, whether it's office, retail, industrial, residential, in the way that banks look at stuff?
Yeah. So depending on the type of property, that could definitely affect your down payment. Mm-hmm. What we typically use in real estate, and this is a very general rule of thumb, is we'll fund 80%, you bring 20% equity to the table. Now that's assuming you're talking about your run-of-the-mill normal commercial space or office retail space. But should you have special purpose type real estate or anything that's atypical, that might have a little bit more of a longer sales cycle should it come on the market, all those go into effect when it comes to the down payment on the property. So all down payments are not created equal when it comes to investment real estate, just as it is with commercial real estate.
Yeah, specialty use and that type of thing. How about like a situation where you have a lot of excess land and stuff like that? I've talked to a few people that they bought a big plot of land with a building on it, and then the intent is to later develop that that obviously will go into like the loan to value and stuff too, right?
It will, but land has a very low land to value. Basically, what you're lending on when you have excess land relative to built and constructed brick and mortar is a potential future value. But until that value is realized, until there's a construction and a building that's instituted and tenants that occupy that space, land typically is between 60 and 65 cents or percent loan to value. There's a recognition that the land has value, but it has no excess value until there's a building with tenants on top of it.
About loan to value, how are we actually getting at the appraised value of the property? Because when I've worked on deals in the
Right.
past, especially on investment real estate deals, I mean, usually the appraisals are doing multiple different types of valuation on it, and
Right.
then we're taking like one of them. So can you talk a little bit about the different methodologies as far as evaluation of
Yeah,
and how that appraisal
there's a number of different ways to appraise and value investment real estate, much more so than you would see with commercial properties, straight owner occupied use properties, because they sometimes use a scattershot approach where one can be like you would see more closely tied to residential properties. You'll see a lot of comps, and comps is a really strong appraisal value when it comes to investment real estate, because it's really tied into the market, and that's what comps is getting. It's driving and boiling down to more of a comp. What has a similar investment real estate? Let's take strip malls. A strip mall within a 5-10 mile radius, roughly the same size. There's 3 to 4 comps usually. I've seen sometimes as many as 6, but they'll take an average of those comps to derive your appraised value. Oftentimes, I've seen in lockstep with something that's called like a cap rate,
Yeah.
or your net operating income derivative. And basically, this fancy way of saying they're looking at the net income derived by the property relative to its value, and again comparing that to market value to derive an appraised value. And depending on if your cap rate is high or low relative to the market, we'll definitely have a strong indication on how that property is appraised.
So at a real high level, can you kind of tell us how cap rates are calculated? I mean, it's a basic calculation, really.
Yeah, it's a basic. So you start with NOI, net operating income. That's the at the end of the day, the bottom line revenue that is generated by an investment property, and it's divided by the assumed value of the property to derive a cap rate. And generally, a lower cap rate signifies a little bit of a lower risk, whereas a higher cap rate signifies a little bit of a higher risk to investors. So when you're looking at cap rate, a general average is anything between, like, I'd say 4 and 10, maybe 5 and 10, is 7 being the sweet spot for cap rate, which will indicate a degree of risk from the investment property.
Yeah, so you'll see a lot of times these high rate credit rated tenants have relatively low cap rates because there's an idea that they are a little bit more stable and those cash flows are more likely to come without any kind of interruption, that they're maintaining the property in a better fashion. So actually, when you're doing your cap rate, though, you really need to know the NOI is calculated, and it's going to be different depending on what type of a lease you have, right?
Right. Oh, yeah, absolutely.
So there's really a few different types of leases, but can we talk about triple net leases versus double
Sure.
net leases and kind of what the differences are and how that would affect
So
your NOI?
there's differences in a triple and a double net lease, and there's also differences in maybe how you're reporting your NOI. So again, your NOI, just like EBITDA, when we discussed in another podcast how there's variables to EBITDA, there's variables to NOI. Very high level, you have rents. Very simple income statement. You have rents, and then you strip out taxes, depreciation, management fees, anything else, obviously. And then your bottom line is your net operating income. Now, when you have a triple net lease, generally that signifies that the tenant is responsible to pay typically the big 3 expenses on that property, being taxes, insurance, and maintenance.
Yep.
Whereas triple net, they're responsible for 2 of those 3: taxes, insurance, and or maintenance. Now, the way I've seen this run through on a number of different NOIs from companies is oftentimes an owner of an investment real estate will accept, a lease inclusive of triple net taxes, maintenance, insurance, etc., and they will line item that out on their income statement as though they've paid it, even though they've been reimbursed for it to, obviously suppress the NOI a little bit. And then there's other times where they do not detail or list out taxes, maintenance, and insurance because that was already paid by the tenant. So if those are built into the NOI, i.e., you've expensed them on the sheet, but the tenant really is the one that paid for those. Those will adjust your NOI accordingly.
So they'll use the cap rate then to get it like a value for that property.
Yeah, so that's more cap rate. Yeah.
Yeah. So then you have the cap rate, you have the comparisons, and then another thing that I see a little bit is like the replacement value of the property. That's kind of less used, but it's used kind of more for insurance purposes. Kind of what it would cost to replace.
That is the straight brick for brick replacement value of the building. It's not necessarily your market value or what it could command on the open market, because I think we all know the value of a property is more than just the cost of everything that goes into the structuring, but the replacement value from that standpoint is, should something happen, what is literally the dollar for dollar, component for component comparison to fully replace this.
Okay, so now you've got all these different values, and you've got the purchase price that you're buying the real estate for. What value is the bank using to kind of to use to get that 80% value?
Oftentimes it's a combination of a comp / cap rate valuation. That's what the bank is going to lend, no more than 80% of that value.
So exactly. So when you're going to buy this building, the third party appraiser, which is typically engaged by the bank but paid for by the purchaser,
correct,
is going to come to a value based on these three valuation methods. And then you also have the purchase price, just similar to when you're buying your own home. And the bank's going to give you 80%, if it's a traditional deal, 80% advance rate on the lesser of those two values.
Right.
Right.
No, that's a good point. Whatever you're, as a buyer, as somebody that's going out and purchasing up investment real estate, it's incumbent on you to do your homework and see where you are relative to the market, because your purchase price and what you've agreed to, that's your purchase price. Yep. The bank won't necessarily lend 80% of that. If a building is worth, round numbers, and it's worth $5 million based on, market valuations, comps, et cetera, the bank will lend 80% of that $5 million. If your purchase price is 6.5, you think it's going to appreciate over time and so on and so forth. Not only are you going to come to the table with the 20% equity loan to value portion of that, you're going to have to inject the additional equity. So
negotiate it down.
Negotiate it down, yeah, because purchase price does not equal appraised value. And as Besim said, which is absolutely right, we're going to take the lower of the two. It's either 80% of your loan to value or your purchase price.
Yeah, and we've actually seen this completely destroy deals before. So that's why I wanted to bring that up, because we've seen it where the valuation, the appraisal and the purchase price are so far off,
right,
that it basically kills a deal.
Right.
And the bank is going to say, okay, well, we have to take independent third parties' appraised value. Technically, you can appeal the appraisal price to the appraiser, but it generally doesn't make any difference.
It's a hard battle to win.
It's very difficult, because they're going to be coming in with all kinds of demographic information, information of purchases bought in a certain way, that they go through all this to get their appraised value. And so once they come to that, they're very unlikely to change the value. And we've seen it kill deals because, the seller's buying it for one price and the appraised comes in for a lower price, and then they have to bring additional cash to the table. And a lot of times they don't have the cash. But we've also seen it work to buyers' advantages, because if the appraisal comes back in lower, they can go back to the seller and say, hey, look, we've done the appraisal, and the bank is saying it's worth this. Well, not the bank, but a third party is saying it's worth this. So there's no way I'm paying X amount. And usually they'll come down a little bit. Maybe it's not all the way down, but it does come, but sometimes they're able to come down. And so we've seen that happen as well.
That can happen, and I've also seen situations where an investor is completely in the money. They've agreed to a purchase price, and the appraisal is well in excess of that. So, obviously, we're going to loan 80% of the agreed purchase price, but I've seen deals where there's an agreed purchase price 2.53 million, and an appraisal comes in at 4. I mean, right off the bat, you're sitting very pretty with excess equity. Right?
And where one place where I've seen that happen a lot, and actually I just worked on a deal like that, and this was an owner occupied deal, but it's similar, is basically we had a company that was renting from a long time, had a lease, and had a lease to buy option with a certain rate in there, and so they exercised their right to purchase the property towards the end of the lease, and they'd been in it so long that the building had appreciated, and they're able to buy the property then at a very low value compared to what market prices were. So
I think you bring up a good point, because that kind of swings to the other half, or I should say the equal half of investment real estate. Let's talk about who's in your building, because you're absolutely right. I think actually oftentimes, especially with very, very long tenured leases, you might have somewhere in there an option to buy at some point in time. But the property is the property. The tenants are really the lifeblood of a lot of the analysis, because brick and mortar valuations, I mean, those are what they are. We all know, generally speaking about that. But here it gets a little unique. It gets a little gray in some areas. And here we're talking about tenants.
Yeah. So, the better the tenant, the longer the lease is, the easier it is to get financing for. It's really as simple as that. If you've got a lot of mom and pop shops in there, nail salons, things that are not multiple location, don't have corporate guarantees associated with them, things like that, there is a view that those are more risky, more likely to deteriorate than if you have Starbucks and Verizon and all these national tenants that have locations all over the place. And on a lot of times, those big companies will have a guarantee from the corporate entity guaranteeing the leases. Right. And so in those cases, the bank and the owner and whatnot, they all feel comfortable that they're going to get paid. And so a lot of time, and so what they do is a lot of times those companies also having sign longer leases. They'll sign a 10-year lease where maybe a nail salon.
I've seen 30-year leases for supermarkets. That's not uncommon.
Yeah, exactly. And so what's happening then is the bank is generally wants to lend to you for their term is not going to be longer than the average of the leases. So if the average lease length is 3.5 years, 4 years, most banks are not going to want to lend past that. But if the average length of the lease is 15 years, then you've got a lot more flexibility. It's easier. It's easier to lend and get a longer term on that. And the amortization is different, but the term will be associated with kind of the average leases.
Right. We're going to tie the maturity to our sort of longest standing repayment source, right? So, every deal I've worked on, literally the first question I ask is for a detailed rent roll, right? Yep. So which tenant is in which space? When did they start their lease? When does their option terminate? What happens after they terminate? Most times you'll see a lease terminate and it goes right to month. Yeah. That can be a scary proposition, because they can pull the plug at any time. Yeah. So tenant strength really becomes a really critical part of the analysis. Just like when we're talking on the commercial side from lending, when we're analyzing the business for a repayment source, here the tenants are the repayment source. So what we typically do, and just banks in general, when they look, is they see at what tipping point does vacancy make the deal not work. Because honest to God, I've seen deals where it's a strip mall. Strip malls are very popular in investment real estate. It's one of the ones you get the most. If you have I've had a deal where there's one pinnacle tenant, I believe a supermarket, don't quote me on that, but it was a supermarket. They had been in there for 30 years. They're not going anywhere. The analysis is just predicated really on that lease. If any other tenants come and go, that's excess income. But we had always run our analysis on, is the supermarket still there? It is. We're good to go. Because, now granted, they also monopolized 75% of the strip mall. So obviously they were paying really, 75% of all the leases and rents going in there. But so long as they're there, we would tie our deal to that. Yeah. And even though that lease had ended at one particular time, and then after that lease was over, it was on a year to year. Now, typically when you go month to month, year to year, it does at times, it can make a financial institution a little bit more uncomfortable, uneasy. But this is a strong pinnacle tenant that had been in there for 35 years. They're clearly,
Sure.
not going anywhere at this point in time. It's an institution. So,
Yeah.
those are the types of things that really go into who's in the building, what type of business is it. This is 2021. A restaurant in a strip mall is not an ideal tenant. They might
Well,
have a signed lease through the end of the year, but they might not make it to the end of the
sure.
year.
Another thing that's really important on those kind of anchor tenants is, if you've got a really strong anchor tenant, it helps to kind of lease out the additional spaces. And then that's why they're called those anchor tenants, is because
Right.
they're bringing in other businesses. And, if you've got a really well-known supermarket, or you've got a Walmart or a Target or whatever it is, that all those other like empty spots around, they're all going to get filled out because people want to capitalize off the traffic that's being brought to them
Right.
by the Target, by those large companies, and so that helps the deal as well. But so the quality of the tenant is very important. I've worked on a lot of single tenant deals where they're corporate guaranteed leases, and the bank loved it. They're like, okay, well, we know
Right.
this is a publicly traded company with AAA rated credit. We don't have a problem. We know we're going to get paid for it. So it makes it much easier to lend to those.
It does. And there's one other facet. So we talked about tenants now as well. One thing that's important to note with tenants, and a bank will look at this relative to the market, is are your rents above or below market? The market dictates, depending on your area code, geography, what type of, businesses they are. There's certain rents at certain levels that, are considered market rents. This is what
Sure.
this type of square footage and this geography mandates. So if you're above market rents, obviously that's better. The market says you charge whatever $40 a square foot, you're charging 45. That's better. But really, when the market dictates you should be at 40 and you're 30, that takes into question, well, why are you offering somebody
Yeah.
below market rents? And that happens for a number of different reasons. One, maybe that's how you could secure a super long-term lease. Two, and you'll see this a lot with, corporately backed leases, they're going to argue a lease for 30, 35 years, but they're going to do so to their benefit as well.
Sure.
If the market says 40, we'll sign 30 years, but you got to give us, 35, 30, maybe $25 per square foot, below market lease. So it's a give and take.
Yeah, and
if you're going to have these shorter term tenants, a bank doesn't want to see kind of a one-off mom and pop shop getting a below market rent, because then that signals you're really struggling to find tenants. You're just going to take the first offer, the first guy that comes in and wants to lease your space. That's not a good sign from an investment in real estate.
And not to go too much off on a tangent, but what I also have seen in this particular space, talking about tenants and whatnot, is I've seen a lot of investors come in, and what they'll do is they'll kind of get a property that has some vacancies or has lower grade tenants, and all they'll do is they'll come in, lease up all the space because they're able to buy it at a lower rate because they don't have as strong of rents, as strong of values. They come in, lease it up, better tenants, and then sell it. And they turn around and sell it. Now you're selling it with stronger tenants with longer leases, and the values are perceived to be way higher. So
Right.
so we see a lot of that as well. One more thing before we get off of tenants that I want to talk about, which I guess it kind of goes into the type of property as well, is depending on the tenant, sometimes they're doing something that can affect the property in a negative way, whether it be environmental or whatnot. Like if you have a tenant in there that's
Right.
doing some kind of chemical thing or whatever, that
Paint shop, something like that.
all those kind of things can cause problems, and so that could derail a deal a little bit. So, if you're looking at a deal, even though they have like a strong tenant, if they're doing something in the property that could damage the property or cause some kind of liability issue,
Right.
that could be something that could be a little bit of a problem. You're right.
Right. And that's all going to come out when we do our environmental due diligence, which, just like flood, you're going to do your flood due diligence,
Sure.
see what kind of floodplain it's in, if it is in one, which could be a deal killer. You're also going to do a due diligence, and the bank really just doesn't at times want to take that risk because, not only is there something to remediate, but, who's paying all those remediation charges? It's hard to repurpose a space for sale when an incoming tenant has to come forth with X amount of leasehold improvements just to fix an issue that wasn't theirs. So yeah, it becomes a real issue. And then obviously environmentally being the other
Yeah.
focus is you got to make sure you're doing it's not going to be of hindrance and you get into some litigation for years and you don't have the money to float that.
Yeah, I mean, I have seen the opposite happen as well. Like, so I have had like some clients that were leasing out these properties to industrial companies, and they'll put in like these huge cranes in their warehouses and
Mhm.
all kinds of other improvements, redo all the driveways, redo like all kinds of fencing and stuff, and it really increases the property value.
Right.
But those tenants
Right.
are planning on being there for 10 or 15 years, and they just kind of think of that's part of the cost of doing business in this particular facility. But when the guy goes out to release the property, now there's been all these improvements. It makes it way better. So,
Sure.
sometimes if you get a good tenant in there, it can really help the value, and especially if you were looking at selling it, because a lot of times people, they
Right.
get, like I said, they get those good tenants in there, and then they sell the business and, sell the building and make some money off it. Okay. Let's kind of get on to the next topic. Okay, Adam, we talked a little bit about the leases, the tenants and those type of things. Let's talk about the personal side. Okay.
Sure.
How does the personal side come into it? Because I've seen it kind of play to effect in a couple of different ways,
Right. Well, personal finances is just like everything else. It's pivotal. It's critical because you are really the man or woman behind the deal, and that takes a couple different forms. One is if you have a lot of investment real estate, you've been doing that for years. On one side of the coin, that's a positive because you have experience with that.
Yeah.
On the other side, it could be a negative if all those properties are highly levered and we see a whole bunch of, there's net worth there, there's value of real estate.
Sure.
None of it's liquid. You have no other liquid assets, be it cash or marketable securities, to really back you up should something happen. Again, there's two sides to every coin. Conversely, if you're in investment real estate and you've never done this before, this is your first property, a lot of banks might not want to dip their toes in the water of somebody that's just starting this for the first time. And also, personally, we're going to look at is how you're going to manage the property because there's different ways to manage a property. A lot of people want to have their hands in the management and they can take care of the day-to-day operations. And a lot of people simply just want it as the investment stream and they pay a management
Yeah.
company to take care of the property. Well, that's not free, So again, as I was talking about earlier with the income side of the house, the income statement, in addition to taxes, depreciation, typically a line item will be management fees, and it can be significant. It can be very impactful if you don't know all that really goes into managing an investment property. This is it's very detailed. It's a full-time job. So again, we'll look at the person, the individual behind it. On are you managing it? Are you paying somebody to manage it? Do you have experience with investment real estate? If you do, how levered are you? So that really completes a complete
That's
picture.
that's interesting point that you brought up and I've seen that a lot is where we look at where banks sometimes will lend to a portfolio of properties. And they're
Yes.
not really lending to an individual property, and like certain
Right.
types of situations. I've seen this a lot. For example, I've seen some commercial banks where they'll do gas station lending, but they won't do less than 5 or 10 locations. And then, so
Right.
if you want to have those as like investment real estate, basically, like you have to do
Mhm.
a portfolio of 10 locations or 20 locations or something like that. And sometimes that's on the owner
Right.
occupied side, but there are situations where they see, like we want to spread out some of the risk associated with this type of a property amongst many locations. Another
Right.
thing,
Yeah. We've had that with those car lube centers as
yeah.
well, where if we'll finance them and we're entirely comfortable doing the portfolio of these types of centers, but if you do it, it has to be in quantity, and that really is like you said to diversify because they're really good revenue generating properties, but the view of doing a portfolio investment is to kind of spread out your risk just like you would with stocks. If one is ticking up, maybe another's ticking down, but the end result is kind of flat, and you can really better predict your revenues and ongoing cash flows to mitigate that.
Yeah. Another thing is I'll see when they're doing where we're doing a valuation on investment real estate, even though it's not making the final decision, there is a view of what is the leverage profile of the entire portfolio of deals? And so what is kind of the average loan to value and things like that? Those are all things that banks are looking at when you're investing in real estate. So they really don't want you to have so even if this particular deal has a low loan to value, if the rest of your portfolio has a very high loan to value, that could be a little bit of an issue. But they like to see a little bit lower, see some equity in the loan to value, that knowing that if something goes wrong, you can liquidate a property, or you're not relying on all those rents and things like that. So there's a lot of times they are looking at the portfolio value. Another thing I think that's important to notice on the personal side is there are certain portions of the bank, like the private banks, like the private wealth management parts of the bank, that will do investment real estate, but they're basing it completely on the personal side. They're basing it completely on what is the cash flow to this individual, and they're not really looking at the property.
Right. Now that's slightly different because
right.
let's just take a street term here. You would call that a rich guy loan.
Yeah.
And what you would mean by that is we're almost agnostic, indifferent, apathetic towards the real estate. We just want to know you can stroke a check in one fell swoop and take care of the debts and liabilities. So yeah, you fall into rich guy loan territory. That's absolutely an option to purchase up real estate.
But there are parts of the bank that don't want to do rich guy loans. So if
100%.
So if you go into your normal commercial part of the bank and you're trying to do a rich guy loan,
a lot of times commercial section, when you go more private wealth, I think that becomes much more of a viable option.
So you kind of need to know who you're talking to, what kind of banker you're talking to, what part of the bank you're talking to, because if you're going in and you're expecting your personal wealth, your personal balance sheet, your personal cash flow to kind of get this deal done, and you're talking to a commercial guy, that's probably not going to be, it's not going to happen there. And he's probably going to refer you then over there, here, you need to talk to, our private wealth side.
Exactly.
Okay. So next thing we're going to talk about here, we had very quickly mentioned it, but let's just talk again real quickly about flood, environmental, and something that people don't think about, which is the assignment of leases and some of those documentation things that come out towards closing that people don't really think about and don't realize that they're going to, especially first-time investors, they don't realize that they're going to have to sign those things.
Explain assignment of lease.
So basically, assignment of lease is a situation where in the event that the loan goes bad, the bank can go directly to the tenants and get the lease payments. Right. So if they have to foreclose on the property or something, they can then get those lease payments from.
And the reason that is because different than commercial properties where we would just take over the property and sell it on the open market, the bank still wants to ensure that in that lag time between when the bank takes it over and one day sells it, there's still a revenue stream that's due to the bank. We're going to collect on the leases. Sure. Until up to and including when we sell it. They also do that for the tenants' benefit, so that they aren't just asked to vacate the property for the owner's shortfall in this, that, or the other. So it protects the bank, it protects the tenant, but the tenant will go from paying the prior owner to the bank, and then there should be some sort of change in ownership or otherwise.
That the reason I wanted to bring this up is because I exactly what you just said. It actually protects the tenant, and I've had borrowers hesitant to get those documentation signed, and they look at it like, I don't want the tenant to know that who's financing my deal, that it's even financed or anything like that, But at the end of the day, it actually provides a protection to the tenant, because they know that if something goes wrong, they're not going to be kicked out, that the building's still going to be maintained, that they still have a place to operate, that their lease is still going to be honored, things like that. So that's something that's important. And there are some documentation that come out in your closing like this, that it's important that, people are kind of aware of and know that those are kind of standard things. And, and people, especially tenants, are understanding most of the time whenever we're getting those signed.
I'll never forget, kind of on a little bit of a lighter side, is when I first got into real estate, because when I first started my career in banking, specifically underwriting, I did a lot of real estate. And one of my buddies I was working with, he always jokingly said, but there was a degree of truth to it. He's like, "Hey, Adam, don't worry about approving this deal. If you got the dirt, you can't get hurt." And to this day, I remember it. I mean, I know he's speaking a little tongue in cheek, but it is a good backstop for the bank. I mean, to a degree, real estate, God's not making any more of it, right? So
Yeah.
if you got the dirt, you can't get hurt. One last question before we go here, Basim. I think the viewers will want to know this as well, is why is your background so much better than mine?
Well, when you live large.
What you in a palatial estate over here? What is this? I got a white door.
I know, man.
You got a full conference room.
Would you mind just opening that door? I'm really curious to see where it goes.
It's my laundry room. It's super fancy. Not as fancy as your office.
Yeah,
so.
yeah. No, we know who's got the bigger house here.
It's fine. Size doesn't necessarily always matter. That's fine.
Oh, yeah. Who's been telling you that lie?
Yeah. Anyway, I just wanted to say. All right, we're gonna have to edit some of this out.
I'm not editing that. I'll do.
All right.
No.
Compose.
One thing I did want to talk to you about real quickly before we go. The last thing is just about talking to different types of banks and what to expect when doing commercial real estate at some of the different types of banks. Because I've seen kind of more community and smaller banks willing to do a little bit more of this type of real estate lending, especially to less sophisticated borrowers. Right. And so I just wanted to really say that if you're going out there and you're looking to buy commercial real estate for investment purposes, make sure you're talking to multiple banks and different types of banks. Okay, because if you're talking to all the major banks and you don't have a lot of experience in this and you don't have a really strong balance sheet, it's going to be more difficult to get some of these things done. But there are a lot of banks, the smaller banks, that this is kind of where they cut their teeth.
Well, this is where they make a lot of money. Yeah. It's a very safe place for them to dabble in. Yeah. And so they're very willing to do it, especially as a lot of the smaller banks, one of their biggest interests is building their balance sheet. And this is a great way to do it. So they're very open and welcoming to doing these types of deal. And I say with less scrutiny, not that they wouldn't, follow all the regulations and so on and so forth, but they're just much more willing to open their book, open their balance sheet for these types of deals. 100%.
Great. Adam.
Basim.
Yeah. I don't think these people have liked and subscribed yet.
Yeah. I mean, if they didn't, this video will definitely put them over the top. All right. Okay. Focus for 30 seconds.
All right, Adam. Well, before we go, real quickly, I'm going to let you sign us off. But before we go, I want to talk to the people out there. Look, guys, we're doing these videos for you. We're hoping you're finding a lot of value in them. We're bringing up topics that, we've talked to friends and family and other people about, and they seem not to know about and be curious to. And so we're trying to give you guys a lot of value. So if you are finding value, make sure you're hitting the subscribe button, hitting the notification bell, and liking and commenting on these videos. We're doing these for you, and we want to make sure that we're providing you the best value. So give us some feedback. Let us know what you want us to talk about in the future, because we've got much more to come. We've got a lot of great guests coming on in the future, and we're really excited to be doing this for you guys. So just let us know, any of your feedback that you have. We're going to tailor this to kind of best fit what you guys are looking for.
Absolutely. No, thanks, Basim. And like you said, please subscribe. We like to see comments as well. So please comment if you want anything additional into what we talked about today. This has been our investment real estate podcast. We hoped you liked it. As always, it's Capital Interactive with Basim and Adam, and we'll see you on the other side.